Let's get straight into the charts now. Joining us from IG is Tony Sycamore. And of course, we're focusing very much on these big tech names. What do we see in terms of momentum on the NASDAQ?
Well, if we look back to last week, the NASDAQ had a pretty ugly end to the week. Its worst week in many, many months. It held some support, which you can see there on the chart, coming in around 19,500-ish. And there's been a tepid type of bounce up until this morning. We obviously had some big earnings from the mega tech names, Tesla and Alphabet. At this point of time, they haven't shot the lights out. And we can see that NASDAQ futures are trading down during the Asian session, down about 0.5%. Now, what we need to be mindful of is this is the daily cash chart. So that market isn't open, but the futures are pointing to a weaker lead. If we see the NASDAQ 100 tonight or tomorrow night break below that support coming in around 19,500, it does to me signify that a deeper pullback is underway, whether it's part of the rotation, which we're seeing into small caps, or just the fact that the big mega tech names haven't delivered on all that optimism and expectations that we see every earnings season. It doesn't really matter. But to me, that is the level we need to be watching coming in from that April 16,973 low. It is 19,400 to 19,500. Break below there could fall 1,000 points.
Ooh, that's a big fall. Okay, let's look at Bitcoin because we had the Ether ETF overnight, but what are you seeing in the crypto space?
It's been a fascinating 2 weeks for Bitcoin, and it's rallied over 28%. 2 weeks, we're seeing it now up towards the top of that trend channel. I've been watching this for months and months now. Natural to see some selling up there, some consolidation after a 28% rally. Has it failed at the top of the range again? Possibly, but at this point of time, I'm seeing it more as a healthy consolidation after a very strong 2-week run. That said, we need to see Bitcoin get above that trend channel resistance and above that 74,000 high from March to confirm that the uptrend has resumed towards 80,000. Until then, we're still in a range.
All right. Well, crude oil, a 6-week low, these expectations potentially of a ceasefire in Gaza, we've heard that before, but also growing demands about China.
Everything's going wrong for crude oil at the moment. In some respects, some of the things which are going wrong are fantastic. We'd love to see a ceasefire in Gaza, but you've had very tepid Chinese data continuing. And not only that, you've got the peak of the US driving season now in the rear vision mirror. So where is that demand going to come from, which everybody talks about is going to push back crude oil back up towards those mid-80s? And to me, there's a real warning bell breaking below that 200-day moving average, which is the orange line. And I think we can probably test that trend line support coming in around $74. Now, whether it wants to break through there or not, I'm not convinced. But at this point in time, while it's below the 200-day moving average, I think you've got to allow the decline to unravel just a little bit further. I'm sure there's some long positions being stripped out of the market now after that very strong recovery from that 72.48 low. That has the potential to trade back to $74.
Okay, well, gold has been on our radar, of course, a lot of focus on, when the Fed is going to cut, but also we just talked about India as well, the momentum in this precious metal. What are you seeing?
It's so many cross currents, and I think one of the clearest ways to cut through that noise is just looking at this chart. And that chart, after months and months of range trading, had that push to new highs last week up to that 24.83 high. Unfortunately, it couldn't sustain it. And what we have here is a failed break. And what that means to me is that with gold now back into the range, that old range was 24.50 on the top side to 22.75-ish on the downside. The risks for me are that gold continues to trade lower towards the bottom of the range. And I'm thinking about the reasons for that. To me, I think the US dollar looks quite well positioned for further gains at this point of time. And that should be, I think, detrimental to gold making further gains and potentially the catalyst for it to trade back towards 22.75.
Where's Aussie going to trade? I finally booked an overseas holiday, Tony. Tell me it's going up.
We're all long the Aussie by definition, aren't we, in Australia, even if it's just because we want to go to Japan or the US or wherever. But look, this is a picture which a week ago was looking pretty robust until that Chinese data came out. And we're now at the lowest levels we've seen there for about 3 months. And you can see why. It's broken below that uptrend support from the April 63.62 low. And it is also now being weighed on by things like copper, for example, down to a 3-month low overnight. Iron ore back trading around $100. Tepid Chinese data. Uncertainty now as to whether the RBA will hike rates again, given the fact that other central banks are moving more firmly towards easing. And that to me suggests that the Aussie can have a look at that 200-day moving average, which is coming in around 65.80. But look, that's markets. The picture there was looking like it was quite positive. We had that Chinese data. We thought the friction from that Chinese data would start to weigh on its ascent. It certainly did that, but now it's just starting to play out in different permutations. Plus the factors I've just mentioned. The US dollar to me, I think, has got further upside. And I think if you're booking the holiday, probably not a bad time to buy some overseas currencies as well.
Should listen to the people I interview. All right, bear market. I mean, we hit 8,000 last week. We're down about 0.2% today. All of those factors, as you mentioned, flying through into that.
I love talking about charts when there's so much to talk about, and this is a perfect example. This time last week, again, breaking to new fresh record highs, 80.83 there, and then the level which it broke out from, which held for 3 months, 7,900, was tested on Monday. Now, at this point of time, the ASX 200 is respecting that support. Former resistance, as we know, becomes support. But if the ASX 200 were to break below 7,900, it would certainly leave that 80.83 high exposed as a false break higher and potentially warn of a deeper decline there. And that, to me, is something we're going to need to probably watch to see as the US headwinds or tailwinds, whatever it turns out to be over this earnings season, play out. I don't think the ASX 200 wants to trade low at this point of time. It has done all the hard work, but it needs some follow through. It needs some tailwinds from the US. I'm just not sure that it's going to get it at this point of time.